Did you know that Warren Buffett is already preparing for the 2025 recession? And more importantly, what does he know that you don't yet about how to protect your portfolio when the recession knocks on your door? In this video, you will discover what opportunities will arise in the market with this new recession, and Buffett's strategies to ensure that your stocks not only survive, but grow in times of economic recession. Maybe the next crisis will be your biggest profit opportunity. Here's what Buffett had to say about this recently.
If you look at stocks as a business and treat the market as something that doesn't tell you, isn't there to instruct you, but it's there to serve you, you'll do a lot better over time.
Buffett's philosophy is simple. Crises create buying opportunities. Well-managed companies with a solid business model and stable cash flow tend to recover quickly, while stock prices drop dramatically, creating a favorable scenario for long-term investors. When we think of Warren Buffett, the first thing that comes to mind is his impressive investment track record and his ability to stay calm amid market volatility. However, he is not the type to ignore the signs of an impending recession. Instead, he uses his experience to prepare, and this involves strategic choices based on three key principles: resilience, patience, and stable cash flow. Buffett always says his strategy is to buy wonderful businesses at reasonable prices, and this intensifies during times of crisis. During the 2008 recession, for example, he bought large stakes in companies like Goldman Sachs and General Electric while the market was in panic. Currently, Buffett is observing the same economic dynamics he saw in the past: rising inflation, high interest rates, and general uncertainty about the future. But instead of panicking like many investors do, he is preparing to buy during the discount that a recession can offer. The idea is not just to survive the crisis, but to use the crisis to acquire high-value companies at low prices. Another crucial point is the issue of debt. During recessions, many companies find themselves overwhelmed with debt they cannot pay, which affects their stability. Buffett, however, has been a strong advocate of no leverage, that is, avoiding excessive debt. His famous bet on the energy company Mid-American is an example of this. The company invests heavily in renewable energy assets, but without taking on large financial risks. This provides additional stability during times of economic turmoil. Why is this important for you? If there is one thing the 2008 crisis taught us, it's that diversification and the selection of resilient assets are essential for navigating tough times. Buffett shows us that the secret lies in focusing on assets with low bankruptcy risk and that don't depend on speculation. Moreover, he has a clear focus on companies that have enduring competitive advantages, the so-called moats, such as those that dominate specific markets and have a loyal customer base. But what does this mean for your investment portfolio? Instead of betting on assets that may be highly volatile, like high-growth tech stocks or real estate in saturated markets, Buffett would prefer to invest in companies that offer essential products or services with a proven track record of crisis resistance. Or in the case of real estate, he would look for properties that generate consistent cash flow and are located in markets where demand is not easily affected by recessions. To prepare for a future recession, you should maintain a portfolio with stocks that are sustainable and pay dividends. If you want to learn how to invest in the stock market, achieve financial freedom, and be part of a community to exchange experiences with like-minded individuals, click the link in the comments. Now that we've looked at some of Buffett's strategies to prepare for the recession, it's essential to understand the current economic context. After all, how does he apply his principles in an environment of economic uncertainty? As of December 2024, the global and U.S. economic landscape is marked by a combination of factors that create uncertainty, but also opportunities for strategic investors like Warren Buffett. Inflation, while showing signs of slowing down after its peak in 2022, remains above the Federal Reserve's target, and interest rates remain elevated, with the Fed keeping rates around 5.25% to 5.50%. The cost of credit remains high, directly affecting the consumer and real estate sectors. Economic slowdown is visible in various indicators. For example, U.S. GDP grew only 1.7% in the third quarter of 2024, which is considerably below growth expectations. This slower growth pace reflects restrictive monetary policies and geopolitical uncertainties, such as the impact of the war in Ukraine and tensions with China, which continue to affect global supply chains. However, even amidst this challenging environment, Buffett maintains an optimistic view about the resilience of fundamental businesses and his long-term strategy. He consistently argues that crises reveal wonderful businesses that become accessible at discounted prices. Buffett, for instance, has continued to invest heavily in renewable energy companies like Occidental Petroleum, which benefit from from the growing demand for clean energy despite economic uncertainties. In this environment, Buffett's patience and long-term vision become even more valuable. The lesson here is clear. While many are focused on short-term risks, you can be focused on the opportunities that a recession may provide in the long run. With this economic landscape in mind, let's now take a closer look at Buffett's investment choices and understand how he selects assets that withstand crises. When faced with a challenging economic scenario like the one we're experiencing, many investors try to react quickly, selling assets or adjusting their portfolios to avoid losses. But Warren Buffett, with his calm and strategic approach, shows us that crises are actually moments of great opportunity for those who know where to look. The main characteristic Buffett looks for in times of crisis is resilience. This means companies that have the ability to generate stable and continuous cash flow regardless of economic fluctuations. During a recession, consumers tend to cut spending on non-essential items but still spend on essential products. And that's exactly what Buffett seeks: companies that sell these indispensable products. During the 2008 recession, Buffett made significant investments in companies like Coca-Cola, which offers a mass-consumed product and remains highly profitable even during economic hardships. In 2024, we see a similar scenario. Companies like Procter & Gamble and Johnson & Johnson, which provide essential consumer goods and pharmaceuticals, are clear examples of wonderful businesses that continue to generate steady profits even during recessions. Another sector Buffett has focused on in recent years is renewable energy. Although the traditional energy sector was hit hard by oil price fluctuations, the transition to more sustainable energy sources remains solid, and the demand for renewable energy continues to grow. Companies like Occidental Petroleum and Berkshire Hathaway Energy, both controlled by Buffett, benefit from a greener and more stable energy market. Buffett is also cautious about companies' debt, especially during recessions. In a high-interest rate environment like the one we are currently in, debt can be a significant burden for companies. Buffett has always said that he prefers companies with low levels of debt, as it makes them more resilient in the face of an economic slowdown. During the 2008 crisis, Buffett bought a significant stake in Goldman Sachs, which was under pressure due to the financial crisis. But he managed to negotiate a favorable deal, purchasing shares with high dividends and favorable payment terms. Regarding the real estate market, Buffett tends to be more selective. Instead of buying properties in saturated markets, he looks for assets that generate consistent cash flow. During the 2008 recession, he steered clear of high-risk real estate markets, but continued to invest in commercial properties with long-term contracts and stable tenants. For example, when Buffett bought NetJets, a private jet company, he focused on assets that serve a high-net-worth clientele, whose demand for such services tends to be less sensitive to economic cycles. Additionally, in the real estate sector, he would look for properties in locations with consistent high demand, such as residential rental properties in areas with population growth and low vacancy rates, or commercial properties in high-demand areas like rental data from large urban centers where the market remains resilient to recession. One of the greatest lessons Warren Buffett teaches us, especially when it comes to preparing for a recession, is that success in investing doesn't depend on short-term predictions, but on a long-term mindset. Buffett always believes that the key to winning in the market is not to panic during downturns and not to be greedy during rallies, but to maintain a disciplined and strategic approach, even when the market is in a state of panic. In times of recession, it's easy to fall into the trap of selling assets because the market is down. However, the true wisdom of a long-term investor is understanding that the market always recovers, and the best opportunities arise when prices are low. Buffett exemplifies this with his famous quote, "If you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This means that short-term volatility should not influence your decisions if you believe in the long-term potential of the asset. A recent example that perfectly illustrates Buffett's long-term mindset is the COVID-19 pandemic. In March 2020, global markets collapsed with the increase in economic uncertainties and the lockdowns of economies. The S&P 500 dropped more than 30% in just 1 month. However, investors who followed the long-term strategy like Buffett took advantage of the drop to invest in solid companies at discounted prices. Buffett, for instance, bought large amounts of Apple stock during the most difficult moments of the pandemic, even though the market was in free fall. By early 2021, when vaccines started being distributed and the global economy began to recover, Apple's stock, along with many other companies he had bought, rebounded, generating significant profits for those who maintained a long-term outlook. Just like in 2020, the long-term mindset allows you to buy quality assets when they're being traded at low prices. During a recession like the one we may face in 2025, the best assets will recover more quickly as the economy stabilizes and grows again. In 2025, with a possible recession on the horizon and a Trump administration implementing aggressive economic policies, Buffett's long-term mindset will be more important than ever. The market may suffer from volatility, especially in riskier sectors such as technology and startups, where prices can fall drastically. However, essential businesses, such as healthcare, consumer staples, and energy, tend to be more resilient. If you are investing in healthcare stocks like Johnson & Johnson, or in renewable energy, with companies like NextEra Energy, these sectors may experience a market value drop in the short term, but if you believe in their long-term growth, these assets are likely to recover, especially if demand for healthcare and clean energy continues to rise as the economy recovers. The opportunity loss in the short term. According to historical data, recessions in the U.S. are usually followed by periods of strong growth. The S&P 500, for example, saw a spectacular recovery after the COVID-19 pandemic, rising more than 70% between March 2020 and the end of 2021. This rapid recovery cycle is typical of many recessions, where initial drops are followed by an accelerated recovery as markets adjust to the new reality and begin to anticipate future growth. So how can you apply this strategy, and how can you adapt your investment portfolio for the future? When it comes to preparing for a recession, one of the most fundamental principles of investing is diversification. Warren Buffett, although famous for his concentrated bets on high-quality companies, has always emphasized the importance of not putting all your eggs in one basket. For most investors, diversification is one of the most effective ways to protect your portfolio against the ups and downs of the market and ensure a smoother recovery after a recession. Here are some directions you can consider when building a diversified portfolio. Resilient sectors. Healthcare and consumer staples. The healthcare sector has traditionally been resilient during recessions. Even in tough times, people need medical care, and companies like Johnson & Johnson, Pfizer, and Merck tend to perform well. Moreover, with the aging U.S. population, the growth of the healthcare sector should continue regardless of the economic cycle. Consumer staples also offer excellent diversification. Companies like Procter & Gamble, Coca-Cola, and PepsiCo provide products that consumers buy in any economic scenario. These assets tend to be less volatile and provide a steady stream of revenue. Cyclical sectors, energy, and infrastructure. During recessions, the energy sector can be volatile, but at the same time, giants like ExxonMobil or Chevron have remarkable recovery potential due to the constant demand for oil and gas. Additionally, if the Trump administration implements new infrastructure projects, companies in the infrastructure sector, such as Caterpillar and United Rentals, may benefit from government contracts and large-scale projects. International diversification, emerging markets, and global stocks. A smart way to diversify during a recession is to look at international markets, especially emerging markets. Countries like China and India have growing economies, and many companies from these countries are becoming increasingly important on the global stage. Investing in global index funds such as the Vanguard Total World Stock ETF, VT, or the iShares MSCI Emerging Markets ETF, EEM, can help protect your portfolio against localized economic risks. Fixed income assets and government bonds. During a recession, U.S. government bonds are one of the best ways to preserve capital. Even though yields may be low, the security of knowing you have a portfolio of assets that won't suffer significant losses during a crisis is crucial. By keeping a significant portion of your portfolio in bonds, you can balance risks and reduce the impact of stock market downturns. Investing in gold and alternative assets. Gold has always been a safe haven asset in times of crisis. During periods of recession, the price of gold tends to rise as investors seek security in tangible assets. If inflation increases or there is uncertainty in the financial system, gold tends to appreciate. Gold ETFs like SPDR Gold Shares, GLD, can be an excellent way to add diversification and protection to your portfolio. Now, if you want to own actual gold, click the link in the pinned comment to buy at fair prices. Remember that diversification is not static. In a recession scenario, you may need to adjust your allocation to ensure your portfolio remains balanced as market conditions change. If a sector performs particularly poorly, it might be a good idea to reduce exposure to that sector and increase allocation to more resilient sectors like healthcare or consumer staples. If you found this information useful, please like and subscribe to the channel. Don't forget to check out the links in the comments. Good investment.